roses were living the dream.
To you, my darling.
No, to you.
Until it all came crashing down.
You got fired.
Fired?
On August 29th, stop.
You stop!
And see The Roses. Rated R. In theaters everywhere, August 29th.
I'm here on the job site with Dale, who's a framing contractor.
Hey, good morning.
Dale traded up to Geico Commercial Auto Insurance for all his business vehicles. We're here where he needs us most.
Yep, they sure are.
We make it easy for him to save on all his insurance needs, all in one place, with coverage that fits his business and bottom line. Oh, I shouldn't have looked down.
It's all right.
We're so far up here.
Look at me. Take a deep breath.
Oh, I'm good. So good.
Get a commercial auto insurance quote today at geico.com and see how much you could save. Get more with Geico.
Two of the best financial advisors that I can find in the USA, and that's, of course, Bob and Ryan Payne of Payne Capital Management. Gentlemen, thanks for joining. A lot to cover, so I want to get right down to it. Bob, I will start with you. I'm confused a little bit about these inflation numbers, Bob. First, we get a good CPI rating, which was around 2%. And then we got these the producer price index number, which was way high. What are we to make of this?
Well, Steve, we always say, one sunny day doesn't make a summer, one rainy day doesn't make a winter. You just can't take one data point and, make much of it. Unfortunately, there's a lot of negative economists out there that are just looking for any kind of tariff-induced inflation,
right?
That they can pin on the Trump administration.
That's right. So I was on that point, Ryan. I was watching Squawk Box the other day, and then and this Andrew Sorkin, who you probably know from the New York Times, who was a big liberal. He was just trashing the Trump economy, saying all these numbers are terrible and good news is bad news. And so if I didn't know anything about economics, my head would be spinning around. But what do you make of the inflation numbers? Should we be worried about another bout of inflation?
I think, look, I think in all fairness, I think the tariff related inflation probably is a little bit delayed, right? It doesn't happen right away.
Right.
If you think about it, companies, they first probably eat that charge. A lot of, if you think of a lot of inventories, they probably bought before the tariffs and they're going to have to buy inventories again at some point. So I think those numbers will bleed into inflation. But I think, the problem here is you can't just use one metric to factor in what's happening with inflation because, one of the largest input factors for inflation is oil. And oil prices are down 15% this year, which is like a global tax cut, right? Companies benefit from that. The average consumer benefits from that. So if you look at it on a whole, and this is why that headline number came in less hot than expected, is because you have a lot of counterbalances out there that are disinflationary and no one's talking about it.
I couldn't agree more. I think you're exactly right about that. And we got the tax cut. We've got the pro-American energy policy with the drill baby drill. And that's starting to bring down the price of oil. Absolutely. And then deregulation, Bob. Deregulation is a cost cutter for businesses.
Deregulation is huge, Steve, and I think that's something that's being overlooked. I mean, there's so many businesses that have been burdened by overregulation that it's just been a breath of fresh air for the last 6 months, and you've already seen that impact on earnings per share. We're hitting another quarter of record earnings with the remaining companies to report. The expectations we're going to be at an all-time record high on earnings, which means we're going to be at an all-time record high on the stock market.
PA ratios, they're too high right now. I don't know, Ryan, what do you think? I haven't been following that, but Bob brought it up.
Yeah. Well, it's a good point because, we all only want to talk about tech, right? That we know tech's doing well, Magnificent Seven's doing well, but historically, those PE ratios are expensive. But when you take the Magnificent Seven out of the equation, right now the global markets are cheap. It's actually mind-blowing if you look at like high-quality European stocks. They're actually growing at the same rate as the Magnificent Seven and trade a lot cheaper, and they pay a lot of dividends. And that's what Bob and I think about with our clients because they need income.
I'm talking to Bob and Ryan Payne of Payne Capital Management. I always forget, is it bebullish.com? What's the website?
Yeah. I wouldn't have it any other way.
Bebullish.com, but it's also, you can also call us at 844-752-6692. That's, 844-PLAN-NYC, Steve. It's easy to get in touch with us.
So I wanted to, by the way, when you say diversify, Ryan, are you talking about diversifying geographically outside the United States?
I think geographically and also within the United States. If you take technology out of the equation, financials have had a phenomenal run for the last 12 months. Industrials, and again, they all pay much higher dividends. They trade a lot cheaper if we talk about PE ratios. And again, if you go global right now, growth rates for high quality stocks in Europe, they're they're literally growing as fast as Magnificent Seven, and they traded at a huge discount. And also, you want to, to some extent, some of President Trump's strategy is to make a weaker dollar for manufacturing and exporting. That's also good for having international assets because those international currencies appreciate when the U.S. dollar depreciates. So it's another diversification you want to have in your portfolio, Steve.
Yeah, but on the other hand, the declining dollar is also inflationary as well. So it's a double-edged sword, isn't it?
That's a good point. But that's also why you want to have inflation hedges in your portfolio, because you have to expect to some extent that could be one of the effects. My best friend in the world is Larry Kudlow, who talks about King Dollar. He loves the strong dollar, but I think we certainly want it stable. And so that brings me to my next and most important question for Bob and Ryan Payne are both with us today. The Fed is meeting. When is that? In the middle of September? When is their meeting?
I think it's late September, Steve, and I think that the odds on right now from all the futures traders is that there's almost a 90% chance that they're going to cut interest rates, at this next meeting. Well, I think 25 basis points, although our Scott Bessent came out the other day. And
are you saying you think that that's what they will do or that they should do?
I think they will do. I think that there's so much pressure on the Federal Reserve right now. Inflation numbers are down low. Oil prices are dropping. Yeah, I think that not only will they, but they should. Yes, I agree.
This episode is brought to you by LifeLock. Between two-factor authentication, strong passwords, and a VPN, you try to be in control of how your info is protected. But many other places also have it, and they might not be as careful. That's why LifeLock monitors hundreds of millions of data points a second for threats. If your identity is stolen, they'll fix it, guaranteed, or your money back. Save up to 40% your first year. Visit LifeLock.com/podcast for 40% off. Terms apply.
Okay, Ryan, you're going to have to break the by the way, I have to tell you guys, I'm kind of on the fence on this. I know all my conservative friends. I see you, Ryan, all the time on Fox Business News. You do a great job. But most of the people on Fox Business are saying, we have to cut rates. I guess I would go for a quarter, maybe 50 basis point reduction. But beyond that, I would be worried about inflation. But where are you on this issue?
Yeah, I agree. I think be careful what you wish for, right? Because we saw this in September. Yeah, no one likes to talk about this, but when Jerome Powell did cut rates last year, which is politicized, we all know that, long-term rates actually went up because one risk here is you could overheat the economy, right? Lowering interest rates makes borrowing cheaper. It gets a lot of money off the sidelines, and I do think that's a real risk. And I think that if Jerome Powell caves to the Fed here, that could actually end up being inflationary. So I think you have a great point there, and I think most economists are not talking about that.
So are you guys betting on a quarter point or 50?
I think a quarter. I think 50 would 25. Be way too aggressive.
25. Okay, I think too. I don't know. I don't know if I think they may do 50, but I think it's 50-50. So last question I wanted to ask you about, and we're probably going to have to finish this discussion next week because it's a big issue. I'm hearing from my friends in Florida and other states that have had really hot housing markets that it's really cooling off. And some of people I really admire and trust, including you, but not necessarily you're not saying this, but are predicting that we're going to see a 10% decline in housing prices. And I wonder, if either of you, Bob or Ryan, have a thought on that.
Well, I think what I've seen, Steve, at the Jersey Shore this summer, for all my large clients that have a lot of investment properties, their rental income's down over 20%. I think prices have reached a point where folks are starting to say, well, maybe I'll go to France instead of South Jersey this year.
Right.
Yeah, I think that's true. I think, the problem here is you have a standstill between buyers and sellers, right? Because sellers still want to sell at prices when interest rates are a lot lower. When you get 3-4% on a mortgage, now you have close to 7% on a mortgage rate. So the economics haven't adjusted to that. So I think you may see a price cut here, but remember, this isn't like the great financial crisis where we had an oversupply of homes.
God forbid.
Yeah, God forbid, right. We have an undersupply of homes, so there's a bid under the market, but I think a price correction here is probably realistic, but nothing like we saw during the great financial crisis. I think housing prices just need to adjust to the fact that mortgage rates are now closer to 7%. It's a different reality.
Well, that's right. And we only got 30 seconds left, Bob. But, a declining mortgage rate is good for the buyer and the seller, right?
Well, unfortunately, Steve, the mortgage rates haven't come down, right? With the 10-year Treasury, even though it's about 4.3% today, you're still looking at close to 7% for mortgages. What blows my mind is this whole big increase in real estate values came with cash buyers. I just always wonder, where does all that cash come from?
Yeah. Well, we will search for an answer to that next week. That's Bob and Ryan Payne of Payne Capital Management, BeBullish.com. And this is the More Money Show, and we'll be right back.
Hey, and if you're thinking to yourself right now, okay, I need to get my finances in order. I need to get my retirement plan in place. Well, here's your shot to do it. Bob and I, for the entire show, will keep 10 slots open. If you saved over $1 million for your retirement, we'll run for you our now famous Total Financial Master Plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. There's not a firm out there that will do this work up front. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement, how to take Social Security, how to draw from your portfolio, factor in inflation, and not run out of money. We're going to build you that dynamic income plan. We're going to look at diversification. Markets have been wild this year. I don't need to tell you. Has your portfolio been way too volatile? Or have you been sitting with way too much money in cash, CDs, money market funds, paralysis by analysis? Well, we'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product, structured product, insurance. We'll go through every investment you own. We'll do a deep dive. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. We have 10 slots. If you saved over $1 million for your retirement, we'll run our Total Financial Master Plan. All you need to do is text or call right now at 844-752-6692. That's 844-752-6692. Speak with one of our financial advisors, certified financial planners at 844-752-6692. That's 844-752-6692. That's 844-PLAN-NYC. That's 844-PLAN-NYC.